Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical performances. With the S&P at a crucial technical spot for its current rally, the next 2 weeks are one of the most pinnacle times in its history. With geopolitical controversy seeming to de-escalate after a major scare 2 days ago, and one of the most important weeks for monetary policy, are stocks ready to keep going, or are we in for another grueling pullback? S&P futures rallied up this morning as news came out that it seems the conflict in Iran has shifted back to de-escalating after a recent scare 2 days ago when the U.S. rescinded Iran's ability to sell Iranian oil. According to Trump, Iran called to make a deal after a series of U.S. strikes. With news regarding Iran seemingly flip-flopping every day, it's difficult to know how transparent and truthful this news is. In recent times, many are skeptical and cautious around updates on the Iran conflict, as history has shown it has no guarantee of continuing to shift a certain way. However, for the sake of world peace, the lives of future innocent people, and less importantly, the markets, this is a sign things could possibly get better after the last 3 months, which has been a nightmare for many. In other news, initial and continuing jobless claims were released this morning at 8:30 a.m., in which we saw lower initial claims than consensus, as well as our previous reporting. We also saw that continuing claims has increased compared to previous, however still below consensus. This tells us that we are seeing a slower rate in which new unemployment is occurring, however a faster and higher rate of those remaining unemployed. Ultimately, in terms of net, we are still seeing unemployment remain higher. So although this reporting was not a shock to investors, it still shows some labor market weakness, which is good for those who want to see the Fed's outlook shift from hawkish to dovish. Remember, arguably the most important economic update coming up next week is CPI on Tuesday at 8:30 a.m. We want to see inflation cooling off, as recently the Fed has informed investors that they are more concerned about inflation risks than slowing growth in the economy. We need a shock to the market that nulls this hawkish narrative of seeing a rate hike this year. Then shortly after, at 10 a.m., we will see Kevin Warsh's testimony, in which we will see where he stands in regards to inflation risks. So let's jump into some S&P price action. The S&P continued to bounce off of our pink trend line like we talked about yesterday, making our bullish breakout of the triangle that we saw last Thursday still valid. This implies we go on to test the swing highs created along the way at 75.78 and 76.20. We also closed past our 78.6 retracement at 75.36, making a strong case that we do actually go on to see the S&P push further to test those swing highs along the way. Now, if we continue to break past 75.78, this validates the ABCD pattern we've been talking about, which calls for a 1.236 to 1.618 retracement of our B2C move. This brings our upwards targets to 76.45 and 77.53 roughly, should we successfully see a break past our B point at 75.78. Now remember not to get too excited by this seemingly bullish price action and remain cautious, as our very important CPI print is being released next Tuesday at 8:30 a.m. This will certainly cause some volatility in the markets, and if it confirms the Fed's current fear of inflation risks, expect to see a pullback in the markets. So the first stock I want to talk about is ticker WYNN, in which we saw a stochastic RSI buy signal this past Tuesday, July 7th, in which WYNN rose on average 18.5% over the next 120 trading days, or roughly 6 months. We've seen 12 triggers in the past 3 years, in which 83% of the time the price was higher when looking at the 120th trading day. Now, it's been performing at about a profit factor of 6, meaning its wins on average were about 6 times larger than its losses when comparing where the price ended up on that 120th day. Now, taking a look at WYNN's reaction to those stochastic RSI buy signals, on the x-axis we have trading days out from the signal, and on the y-axis you have your cumulative percent change. So in other words, what you're viewing here is if you had bought WYNN on each one of those stochastic RSI buy signals and held for 120 trading days, this this would be what your returns would be over time. Now in blue, we have the average return across all the triggers, in which you can see it lead up to that roughly 18.5% on the 120th day. Also notice when looking towards that end of that 6-month period, majority of your prices are in the green, in which 83% of them did end up being in the positive. In yellow, we have 2 active triggers, one that occurred on May 18th of this year, in which you can see it performing out close to about the 40th day right now, very close in line with the average. And in fact, it had a bit of a jump the first month at around 12 to 13%. The second yellow line will begin to populate as WYNN finishes out its 14th reaction. The last thing I want to know is a significant amount of the reactions had somewhat drawdowns in the first 3 months, at sometimes extremes of 20% below the trigger price. So what this tells you is there's potentially an opportunity to get WYNN at even cheaper prices over the next 3 months before it goes on to really jump up in price and potentially see that 18.5% return we've seen on average. So I went ahead and marked what that 18.5% return on average would look like should it achieve it this time around, bringing it to about $114 a share, leading into towards the end of December of this year. I put a stop loss about 6% to respect the 3-to-1 ratio, with the downside risk to about 90.5 a share. I also went ahead and marked some major support and resistance zones as trading within currently, and 2 major ones, one being a resistance between 107 and roughly 112, and a major support zone between roughly 94 and 100. In terms of larger scale, you'll notice we actually recently broke out of a very long-standing trend line. This occurred back in June of last year. And so as you can see, we had a bit of a bullish run to test some of the pivot highs along the way. And now seems to be retesting this trend line that we broke almost a year ago. And notice we have a very large support zone or support trend line in which it's bounced off fairly vigorously, right? So if we do come back down to this zone, potentially that's a great DCA or buy the dip opportunity, if you will, exclusive of what we're talking about here. So taking a closer look at the actual reaction, notice we had our previous reaction on April 15th this year, and we had quite a bit of a bump. It looks to be trying to do the same as what we saw in April. Now, should we start trading upwards outside of the support zone, right, that could be a really good indication that we're going on to test this resistance zone at around 107 to 112. The second stock I want to talk about today is GRMN or Garmin. We recently saw a bullish cross over its simple moving average. We've seen 10 of these signals in roughly the past 7 years, in which the price rose on average about 15.8% over the next 120 trading days, or just about 6 months. Across the 10 triggers, 70% of the time, or 7 out of the 10 times, the price was higher when looking at that 120th trading day. Now, this signal has been performing at a profit factor of just about 5, meaning its wins on average were about 5 times larger than its losses. We saw an 11th trigger set off this past Tuesday, July 7th, and so it'll definitely be interesting to see if we see similar returns this time around. Taking a look at Garmin's reactions to those simple moving average crosses, we can see really there's only one situation of the 10 historical triggers that really went bad. For a majority of the duration of that 6-month period, we are in the green. In the blue, you can see it lead up to that roughly 15.8% average on the 120th day. And ultimately, towards the very end as well, you can see the 3 reactions that ended up in the negative. Prior to that, 2 of them were actually in the positive, fairly positive, one being up 20%, the other roughly about 6%. So you can see we had a pretty stark drop towards that last month of the reaction. So I went ahead and plotted what that 15.8% average would look like, bring it to just about $288 a share leading into December 24th of this year. So a few things I want to point out majorly. One, it's trading within a major support and resistance zone currently. We also have one back very low around 179, 170. Ultimately, these two are the most important at the moment. As you can see, we're bouncing off that support zone currently and broke out of the consolidation we've been building since early May of this year. The fact that we came to retest it today and are still bouncing off is a really good sign that we do go on to push up further. If you do start trading back into this consolidation zone, right, this could be a signal that it's not quite ready to go yet, and you may see actually a pullback down to the support zone, if not a retest of our major trend line we've been developing since early April of last year. Funny enough, this is actually one of the stocks we talked about earlier this year. It's one of my first videos. It's really cool to see how it's played out over that 6-month period. And so we have another one again. Let's see if we see similar returns this time around. So the last stock I'm going to talk about here is XOM. In the top panel, you're viewing its price over the past roughly 7 years. And in the bottom, you're seeing its premium or discount to its 100-day moving average. So in other words, whenever you see it at -10, for example, that means it's 10% below its 100-day moving average currently. Now, we've seen 12 times in which XOM dropped more than about 8% of its 100-day moving average and then crossed back above that threshold, in which it jumped about 24.6% on average over the following 115 trading days, or just about 5 months and 3 weeks. Something I really want to emphasize is it's currently performing at a 100% win rate, meaning of those 12 historical triggers, the price never failed to be higher on that 115th trading day. With a 13th trigger setting off this past Tuesday, July 7th, it'll be exciting to see if we get similar returns this time around. Taking a look at the reactions in blue, you can see that average lead up to just about that 25% on the 115th trading day. And also notice once you get to the right side of the screen, not a single reaction is in the red. Generally speaking, this is one of the better event studies you can see, where you're seeing fairly strong upside potential and your downside potential is fairly limited. As you can see, majority of the reactions never really went negative. If so, it dropped about 5 to 8% relative to that trigger price. So I went ahead and plotted what that 24.5 average return would look like. Bring it to just about $177 a share leading into December 17th. I also went ahead and put a roughly 8% stop loss to respect a 3-to-1 ratio. And there's some few major things I want to point out here. One, we just actually validated in head and shoulders pattern, right? So generally what this means is whenever you have, a shoulder, a head, and then another shoulder, and you break below the neckline that was developed along these 3 humps, this usually will call for a drop of similar length to the base of your neckline to the peak of your head, right? So if this were to complete out the full head and shoulders pattern, that would bring it down to just about $128.50 a share. Now, I think a good indicator to know if we are going to, in fact, break lower to test and finish out this head and shoulders pattern is going to be our 200-day moving average. Generally speaking, if we see this start trading below the 200-day moving average, that's going to be fairly bearish and could be a good indication that we are going to go on to retest, that head and shoulders pattern as target, as well as some of these major support zones that have gone untested since January of this year. The last thing I want to point out with XOM is I went ahead and pulled out the 100-day simple moving average as well. Remember, with mean reversion strategies, generally your target's going to be the average itself that you're measuring a distance to. Anything beyond that is a cherry on top. And so really, whenever you do reach, the moving average with mean reversion strategies, you want to take some off the plate, as this is typically a pivot point in which it begins to come back down if it's going to. Ultimately, if you see it trade through and with little resistance, that could be a good sign to continue some of your position for the full, 120-day duration, for example. But as you can see, we dropped just about 10%, right? and then crossed back above that 8% threshold just about, right? So it was this close this past Tuesday. So we dipped into that mean reversion zone. Notice, we failed to go much lower and, attempted to pop out. So the big thing you're going to focus on now is, do we hold the 200-day MA and begin trading back up again? If so, right, maybe target the 100-day moving average first. If you start seeing resistance, maybe take some off the plate. If it starts to push through, right, that could be a great sign that we potentially go on to see the 24.5 average that we saw historically across those 12 triggers. So that's everything for today. If you enjoyed the video, please give it a like and subscribe, and I hope to see you in the next video.